Hey everyone, it's Mike Andes. If you don't know who I am, I'm the founder of Augusta Lawn Care. We have over 70 locations around North America. And today I'm actually sharing a long video. So maybe wait for this one or maybe listen to it while you're mowing lawns or doing some landscaping. It's gonna be a great video, I believe, for all of us to listen to. And it's actually a recording of a keynote that I made on last year's conference. So every single year in January, we have a landscape summit. And last year we had to have it virtual because of COVID-19 and the restrictions that were in our state. So we had to have it virtually over Zoom. So this is a recording of what we played live that evening, the very first evening of the event. So this is Landscape Summit 2021, which is about 10, 11 months ago from the time I'm recording this. And in just a few more weeks though, we are having Landscape Summit 2022. So if you're watching this prior to then, I really recommend you come. It's a great event. And if you like this video, that's very long and very educational, if you like it, I guarantee you want to make sure you come to this year's event. I'm going to be really leaning into this type of content this coming year. So I think everyone will benefit, right, from someone who's just getting started and really trying to grow, all the way to a larger style business that's doing multiple millions in revenue. I think it's gonna be a great event to bring your managers to, your spouse to, get on the same page, create a marketing plan for 2022. It's gonna be a great event. So make sure you come. Just go to landscapesummit.co. That's landscapesummit.co. And that will redirect you to the page where you can sign up. It's $299. Every single penny goes into the event. We don't make any money. I lose money on this whole thing. So I really want to make this the event that I always wish I had when I started my lawn care business, my landscaping business, and I think it's going to be awesome. So please go ahead and sign up for that now. And without any further delay, let's go ahead and roll this. Again, this is the Thursday evening, one of the first keynotes of last year's event that was recorded. It was virtual. This year is in person. It's going to be great. I look forward to seeing you there. All right, let's go ahead and get started. And so for the next 45 minutes to an hour, I want to talk about Feed the Beast. And really what we're talking about is the importance and value of marketing in a small business. And I think, especially for young entrepreneurs, young landscapers, I think a lot of times we're always hearing people like Grant Cardone or people like Gary Vaynerchuk or these people we look up to, these kind of celebrity entrepreneurs. And a lot of times think that we need to be investing elsewhere besides our business, whether it be the stock market or real estate or doing these other things. And I think what we sometimes forget is that really a small business is the most, and we're gonna give you numbers and everything in just a moment, is literally the best investment vehicle that you can have if the business is being run correctly. So we're gonna talk about that a little bit and talk about feeding the beast in terms of that beast wants to run, that beast wants to go. It wants to really expand and grow the business, the beast, but you've gotta feed it. And that comes to marketing. And a lot of times people get scared when I say, oh, you gotta spend $5,000, $10,000 in marketing, or like spend $20,000, we spent X amount in marketing. They get freaked out. I wanna talk about why it's so important to feed the beast and why doing so is actually an incredible ROI. If you look at and you compare it to stocks, you compare it to real estate and all the rest of it. So we're gonna jump into that. But before we do that, I wanna talk about the 7 main levers to improve cash flow and returns in your business, all right? So 7 levers that you can really improve your business. And really throughout this whole weekend, the things that we talk about from an operational and tactical standpoint, most of them are revolving around one of these 7 things. All right, so number 1 is price. And so obviously this is a lever that you can pull. Price is, you can increase price. By increasing price, you are able to increase your margin, you're able to charge more, therefore you're able to pay your employees more, therefore you're able to buy more equipment, therefore you're able to spend more on marketing. Price is a massive lever. When COVID happened and our gym closed down, when we opened back up, we tripled the price. We tripled the price of our one-on-one coaching as well as team group training. So basically anything to do with a personal trainer or a group trainer, literally we 3x the price, which is completely counterintuitive to what so many people were doing at the time, because they were thinking like, oh, because of COVID, people don't have a job, people are on unemployment, people are conserving and saving money. And so it seemed counterintuitive, but what I had to realize is like, look, if I can do, let's say for example, right now we're doing training, right? And we were, let's say 50% profitable on all training services, okay? So if I take this And this is now, we're 50% profit. So 50% profit, and then the other cost of the trainer, overhead, whatever it might be, okay? Now, if I triple the price, literally what I did is simply did this, where I have turned the same exact type of training, the same type of material, just the way it's presented and literally the price. I've turned this from a 50% margin business to about an 80% margin part of the business simply by increasing the price. One of the biggest levers in your business. Literally, I could now sell 5 times, like literally 5 times as much training, like in the old days. If I would have sold 5 times as much training, I would have profited the same amount as I did with this triple in price. So price is a massive lever. Obviously, when you raise price, most of that price increase is going directly to your bottom line. So if your profit margin is 10%, 10%, that's your profit margin, and you increase your prices by 5%, literally you go from 10% to 15% margin, and literally you have increased your margin by a factor of 50%. Like literally just by raising your price 5%. So that is literally going from $50 an hour to $55 an hour. Simply by doing that, you will increase your profitability by 50%. That is what you call a lever. All right, a lever is something that when you pull on it, there is a lot of, there's a fulcrum, and that means that there's a whole bunch of reaction from the other side. It's like a teeter-totter, for example. So if I take a teeter-totter, this is the fulcrum, this is the center point of, I'm going way off my notes here, but this is gonna help somebody hopefully increase their prices. And that is, this is the fulcrum, this is the point in which the center of, the point of the center. Now, if I move this fulcrum this direction, so I move it this way, and now, when I put this out, the fulcrum is right here. What happens now is this has become a lever. I like to call this a potential action, potential reaction that's about to happen. Because literally, I can move this side of the fulcrum, I can move this, say, 1 foot down, and if I do that, it's literally gonna swing this thing up all the way and move it till it's about here. So what that means is that I like to look at levers in the business. That's what we're talking about, the 7 levers in your business that you can pull on and make a massive change in your company. These are the 7 things that we're talking about. That's what a lever is. Changing your price by 5% right here literally can increase your margin by 50%, going from 10% to 15%. By the way, that's literally taking an average landscaping company into a very profitable company according to industry standards. 10%, very average. 15% above, very, very good, okay? So when I say that you get raise your prices by 5%, again, not rocket science. We're literally gonna take our $50 per hour, $50 is now going to become $55 per hour. Maybe in the past we charged a dumping fee of $100. Well, guess what? That's going to 110. Wait, no, 5%. It's not even, what do we do here? We messed up. Look at this. I made a mistake. So we're not even raising it from 50 to 55. That's a 10% increase. Literally, we're only moving that to 52.50. 5% increase in price. Literally, every single one watching this video could raise their hourly rate by 5%. No problem, okay? Well, if you charge $100 on a dumping fee, we're gonna charge 5% more, you're literally gonna go from $100 to $105. Literally, that's all you're going to do. You're changing your price by 5%, a little bit, and it's causing a massive change in your business. Price is one of the biggest levers in your business, and when we changed it at the gym, we dramatically changed the business model to focus more on training, because I want to focus on that thing that's 80% profitable and not some other thing that's 10, 15, 20% margin. So again, price is one of your biggest levers. Again, if you're going to actually raise your prices by 5%, you can't just do it to labor. If you're going to do it, you need to go across the board, to dumping fees, to product. If you charge a product cost per yard or per plants, that markup, everything going up just 5%. All of your prices up 5% literally can take your business from 10% to 15%, which is a 50% increase in profit. Because if over here, I made $100,000 in profit, over here, I'm making $150,000 in profit. Literally, by changing my prices 5%. By changing my hourly rate from 50 to 52.50, 5% difference, doing all these other tiny little changes that are so minuscule, that tiny little bit of pressure on this lever makes an incredible difference. You literally gained $50,000. That is incredible. All right, so price, that's the first one that we want to talk about, and we just talked about in terms of a lever. The next thing is volume. All right, so let me just erase all of this. So maybe right now you have 500 customers, you could become 600 customers. By doing that, you can increase the size of your business. That's a massive lever to be able to improve the return on your business. So number 2, if I can write it here, is volume. Sell more units. All right, so if I put this, I'd say, increase price. Here, that's a lever. Here is increase units sold. Now, you could think about it in terms of customers, like number of customers, but I would actually almost think about volume in terms of how many cuts do you have per year? How many times do you service their property? Do you get 1 or do you get 2 cleanups? Do you get 1 in fall and spring or just the fall? Do you get fertilization? Do you get these other services that are ancillary? These are all, the volume game is usually where people focus on to grow their business. And you've heard me talk about this before. We'll talk about it more on Saturday in terms of people focus on this one usually first, when I don't feel it's the first thing you should do, and that is just adding more services so that you can increase the volume of visits and the volume of services provided to each customer. All right, so if you're mowing lawns, an easy way to increase number of units sold or number of services per year is simply by adding fertilization, simply by adding in weed control, simply by adding in bush trimming, simply by adding in fall cleanups, and all of a sudden you're on a slippery slope to just consistently and constantly adding more and more volume. Not a great lever in my opinion, but definitely something that can be used in your business to increase the leverage of your company. All right, so if I'm doing a mowing only company, I'm doing $2 million in revenue, and I was approached by this person like, look, we've tapped out, we've raised our prices, we're premium in the market. I said, okay, well, what if we added a fertilization unit? Could we literally have a 50 to 60% profit margin because we could instantly get $500,000 in annual revenue just by emailing all of your existing mowing customers? Because you have 2,000 of them. Why don't we just email all of them, sell them a new service, and increase volume? Maybe not the best thing to do because again, you're adding complexity to the business, but that is absolutely a lever in the business. The third thing, cost of goods sold. So reducing cost of goods sold, so reducing COGS, is going to be another lever in the business. So we're going to talk about COGS probably, I think it's either tomorrow or Saturday. We're going to talk about COGS. Cost of goods sold really is a breakdown of cost of labor. So I'll actually write this down. We'll talk very much more in detail later on in the conference, so don't worry about this too much. Cost of labor, then we have cost of materials, and then if you have any subcontractors or anything like that. So if you add subcontractors. So we'll talk about this later in the conference, some of the averages in terms of percentage that you should be finding. When it comes to COGS, cost of labor, cost of materials, and your subcontractors. Now, can you decrease your COGS? Can you decrease your cost of goods sold? So for example, cost of labor, we're going to be talking about P for P. Definitely a great way to reduce your COGS, reduce your cost of labor, is by implementing P for P. Better yet, maybe not even in reducing the cost, but increasing the efficiency of that labor that you are spending on. Cost of materials. Could you go out? Could you go to your suppliers? Have you ever thought about trying to haggle with your suppliers? Have you talked about trying to get price discounts if you order 40 yards of material at a time or 50 yards of material at a time instead of getting it 2 or 3 yards a day? Maybe saving $500 a month is worth putting up a bin with ecology blocks and storing that material at your yard. For example, again, always trying to think about cost of goods sold. How can you decrease that? Your subcontractors, are you actually getting enough bids to make sure they're price competitive? Or maybe you should cut subcontractors out completely because you aren't making enough margin, or they're costing you so much in labor just to manage those subcontractors, and you just cut them out completely out of your business by perhaps maybe adding their service,
volume, or just completely eliminating that part of the business completely and simplifying the business 100%. These are all things you can do to reduce your COGS. Cost of goods sold is your labor, materials, and subcontractors. I think I'm always amazed at how people always will think about growth and expansion when literally they are bleeding efficiency when it comes to labor, and they are literally bleeding money every single day because of waste in their materials. So we talked about cost of materials as part of COGS. Literally, they have plants that are dying in their yard that have sat there from overage from a project. They have literally 10, 20, 30 pallets of pavers that are all leftovers. They've been sitting for years and literally have like the whole watermark and the whole bit because they've been sitting there for so long. They're never going to get used, and maybe they have a half pallet of this type and a half pallet of this type, or these are kind of half cut. These were a mess up job, and all of a sudden cost of goods sold starts to increase because of lack of efficiencies and waste in the business. We're going to talk a lot about simplification, and that's a big piece of reducing waste when it comes to cost of materials. All right, number 4, again, we're talking about the levers you have in your business to really increase the returns. All right, next one is operating expenses. Operating expenses. We're going to talk again a lot more about some of these numbers and different types of operating expenses, etc., later on in the conference. So you can obviously reduce these is a huge objective. All right, this is a big reason behind why we have Command Center at Augusta, is to reduce the operating expenses for the franchisees of having an office, having someone have an office manager, having coffee for everyone, having a toilet, having plumbing, having electric, having internet at an office. That's one of the biggest killers for a business, and that's why we have Command Center for the franchisees. You don't have to be a franchisee to realize that operating expenses can eat up your business. Having too much management, having all these project managers that you want to have because it's cool to call them that, or they like the title, is literally could be eating in your profit margin simply due to the fact that they are not producing revenue. All right, we're going to talk about later again in the conference in terms of non-revenue producing employees versus revenue producing employees. You want to do everything you possibly can in your business to take out and remove or simplify the roles of the people who are not actually producing revenue for your business. And when I talk about producing revenue, I don't mean selling jobs. I mean actually doing the work that we get paid for. Because until we actually do the work, until we trim the bush, until we install the mulch, until we pull the weeds, until we cut the grass, we don't actually make money. We can sell jobs all day long as an estimator or a salesperson, but until the work is done, no revenue is generated. And so one of the biggest killers for operating expenses in this industry is they have an owner and they're literally trying to I'm going to work on my business. I'm not going to work in the field. And they have like 2 employees. It's ridiculous. 1/3 of their labor force is considered an operating expense. The estimator. Yes, it's the owner, but you cost money. And then I see sometimes they'll have 5 or 6 employees, and then they have like an office manager, an estimator, a project manager, and themselves. And literally they have 4 people out of 10 that are completely an operating expense. They do not produce revenue for the business. They literally answer emails, answer phone calls, sell jobs, manage jobs, but don't actually do the labor that is required to make revenue. Very, very important, and something I think is overlooked in our industry, especially as people grow. It's very easy to be like, oh, I need a manager for the office, then I need a manager for projects, then I need a manager for mowing, and all of a sudden it's like, look, half of your team is literally not even producing revenue. And we're gonna talk more about ratios in terms of like, why would you have a 1-to-2 ratio? Like, why would you have a 1-to-1 ratio where you're like, for every person in the field, I need someone in the office. Or I need an estimator, or I need someone that's literally just driving around doing quality control. You've heard me talk about quality control and how I think P4P can wipe out that role of quality control, because with P4P, people are coming and checking every single time by making sure that the crew before them did their work correctly. And so I really believe things like quality control, having a non-revenue producing employee, driving a truck, an asset that should be out mowing lawns, having them drive around all day, usually a higher paid employee, by the way, most experienced, highest paid, and yet they're driving around not producing revenue. Massive operating expense. Reducing that is an absolute lever in your business, because every single dollar that you can cut off of operating expenses goes directly to the bottom line. Being very efficient in here in the operating expense lever is extremely important. Number 5 is accounts receivable. Receivable. So how is this a lever? you can reduce the time it takes to collect on accounts receivable, on people that owe you money. So this is the $5,000 project that they still owe you $3,000, and 2 months later you're still trying to get the money. Reducing the time that it takes for you to get this money is so important, especially as you grow. I cannot overemphasize the fact of how many companies I've seen that are profitable on paper, but literally every single day are checking their bank account and like don't have enough money, and they're wondering if they can hit payroll because they're running a $400,000 run rate every single year, and they have $100,000. I've seen this, $400,000 in total gross revenue for the year and almost $100,000 in accounts receivable. You will never be able to grow the business, and literally on paper that business looked to be about 15% profit. Like, it looked good on paper from an accrual accounting standpoint, which takes the money when the job is done, but from the cash standpoint of like money in the bank, we actually received the money, they were like incredibly long period of time to collect on the money and to get the money to them. What can you do to that? What can you do to make sure that your accounts receivable is reduced in time? You can accept credit cards. You can make sure you get at least 50% down before the job starts. You can make sure that literally the moment that someone's card gets stopped or a card gets declined, you don't keep mowing them for 2 months and then try to send them to collections for an exorbitant amount of money. No, you stop right away. What's that doing? It's making sure that you don't have accounts that literally are 3 months old, 4 months old, and then all of a sudden December rolls around, you're trying to collect money from a mowing job that you did in March. Like, that's ludicrous. You're not going to get that money, and we're not a bank. We are not a bank that literally does all these services for someone and then bills them a month later and then lets them go like 3 months without charging them extra, without giving them extra fees. We are not a bank. We are a service-based business, and we expect to get paid. If someone's card declines, if someone doesn't want to pay, you stop doing service for them. What that's going to do is make sure that you're not doing a bunch of work where cash is outside of the business. So what happens here, as you increase the time of accounts receivable, cash flow is very difficult because you got money coming in here, but then you got money going out at a faster rate. And what's going to happen, this literally over here is accounts receivable. This is cash flow. And what happens is this starts building up. Like, this is potential. These could become arrows. These could become cash flow into the business. This is your outflow. And what happens is if you continually are doing this where there's a little bit of money coming in, but more is going out, eventually your cash flow gets wiped out. Eventually there is no more cash flow, and you need to make sure that this accounts receivable, how this can get fixed is simply by making sure that more of these arrows, more of your accounts receivable become cash flow faster. All right, accepting credit cards, great. Okay, accepting 50% down or more on a project, great. I've seen people that require 100% of projects, even if they're $10,000, $15,000, to be paid up before you even get started on the job. But at least 50%, because 50% should cover your what? COGS. All right, so if 50% can cover your cost of materials, cost of labor, and your subcontractors, great, because when you show up on the project, you know that you at least have 50%. Okay. What that's doing is making sure that you have cash flow even before your out begins in the terms of salary, buying the materials, etc. Helping your cash flow when you can accept payments beforehand is great. I've seen some people go as far to accept payment on mowing prior to the month beginning. It's like, look, you're gonna get 3 mows this month. We're gonna charge you 40 per. We're charging 120 on the first, and then we'll do services for those 3. Again, what's that doing? You're getting the money in before the money goes out. What too many people do is they pay payroll, they pay for their trucks, they pay for fuel, and then they literally just wait for the money to come in a month later, 2 months later, 3 months later, and that's what leads to a massive deficit in cash flow, even though on paper they're profitable. All right, so another lever, making sure accounts receivable, that time is decreased. Another thing you can do is on your invoices, don't need to be rude about it. You don't need to threaten people. You can just be very open and honest. Be like, look, we really appreciate when our customers pay within 7 days. It allows us to be able to pay our employees and continue to produce a consistently high quality product and our services. And literally just being really nice about it. Same thing with your automations and your follow-up process. If you don't have automations, the call that you have a day, 2 days, 5 days after they have got their invoice, follow up with them right away. You'd rather get that payment a few days after and feel like you're kind of harassing them than 3 months later giving them a call when now the grass that you cut is 3 feet tall again and you have no proof. So again, very, very important, accounts receivable. The sooner you can collect the money that you are owed, the better. Number 6. Another lever in your business. These are all things that literally you could take an entire conference on and just talk about raising prices. Just talk about adding services and more cuts and adding an extra service like mulch to your offering to your customers, and therefore increase the number of units sold or the number of services sold. You could take an entire conference on COGS and how to reduce them and operational efficiencies and reducing your, number 4, operating expenses. Same thing that counts, like every single one of these is a massive topic and a lever that if you changed one thing, if you did this entire conference and literally just the price thing that we talked about, raising your prices 5% across the board, could completely change your business. Again, remember the lever example. One little change creates a massive amount of ripple effect and change in your business. Number 6, inventory. And this would be for like a product-based business. For us in the service-based business, this is going to be work in progress. This is also called WOP, or work in progress. WOP. All right, so what can you do? I'm sorry, WIP. Sorry, not WOP. WOP, WIP, work in progress. So what you want to do is reduce this, all right? Again, you do not need 10 pallets of pavers, all different types, shapes you're never going to use. That inventory, not good. And even if you know you're going to use those 10 pallets of pavers, make sure you're going to use them in the next few weeks. Not sometime this year, or we install those pavers a couple times a year, we're just gonna store them. Inventory is money burning, all right? If you take inflation alone, the value of that is literally eating away at you, and it's gonna kill you from a cash flow standpoint. Again, because you have literally put out for inventory without making any money in terms of cash flow, all right? So by having inventory and work in progress, your out is there. Having work in progress. This is that 4-week job that has now turned into a 6-week project because of rain, because of delays, because the material didn't show up on time, and now all of a sudden you maybe did collect a deposit on the job, but now you're 90% of the way through the project and you're waiting for the last little bit of material to show up. You're waiting for a nice sunny day. All of those things increase the work in progress, and now you're no longer ahead of schedule in terms of your deposit versus the work performed or work in progress. Now, some people can get around this by, again, collecting 50% to get the job on the schedule, 25% when they're halfway through the project, and then collecting the last 25% before the job is finished. But again, if you're not doing that, work in progress can kill you because you're waiting for that last little bit of the job to finish up before you can charge the rest of the invoice. So work in progress will kill you. This is not as important when it comes to mowing, because we usually don't have a whole lot of work in progress. We don't, mowing takes all of 30 minutes, an hour to get someone's property done. We do not have a lot of work in progress or inventory in terms of like product and materials and things like that. I would say even when it comes to inventory, I look at equipment like inventory. We're gonna talk a lot about efficiencies when it comes to your assets and making sure your utilization is high. But I look at a tractor that's sitting there. If I use it once a month, that's like inventory. It's sitting there. It has potential, all right? It has potential, but it's costing me money. That inventory, that work in progress, those things will kill you, especially landscaping and design build type of things, but also it can do certain elements of the maintenance industry as well. All right, number 7, another lever in your business is accounts payable. Now, again, this is something that I think a lot of times we don't look at because we are not a product-based business, and usually we're thinking in terms of services. But what you want to do here is increase the amount of time, the opposite of accounts receivable. In this part, you want to decrease the time. When it comes to accounts, here, let me erase this. Accounts payable, you want to increase the time. In other words, can you get an account set up with your suppliers? If you have a yard or a dealer that does your maintenance or does work on your trucks and your equipment or whatever it might be, can you ask them, hey, can you bill me at the end of every month? Or can you bill me every other month and just keep a tally of all my stuff? That is an awesome way to increase the time before you have to do any sort of payout. Again, what you're doing is you're reducing this, you're reducing the outflow while the money is coming in, and then you're paying later on down the road once you've collected the money actually coming in. All right, so how can you increase the time of your accounts payable? Things like asking your dealer to pay at the end of each month, having an account with your business where it just tallies up. Go to Home Depot, go to Lowe's. They will set up an account that they will bill you at the end of every single month. These are all different types of accounts payable. Who are you paying? Where's money going out to? And how can you make sure that you don't spend that right away? A credit card, great way to kind of do this, because without paying any interest, you can have an entire month before you actually have to pay on that given expense. All right, even if you're just paying it off every single month, you have a few weeks before you actually have to pay for that bill. So in terms of cash flow, another great lever.
Hey, just a quick intermission here in the middle of the video. I hope you're enjoying it so far. There's a lot more to come, and just wait till we get to the spreadsheets. This is going to be great. But I wanted to make sure that you already, if you haven't already, in the past 30, 40 minutes you've been watching this, make sure you go to landscapesummit.co and sign up for this coming year's event. This virtual event that we had last year was great, but there's nothing that beats meeting other landscape business owners, meeting them in person, connecting, getting their cell phone number, asking them questions, getting to know other people that are in this industry that are trying to do things that are great, trying to change the level of professionalism in this industry together, trying to improve our margins, help our employees. That's the type of people that are going to be at Landscape Summit. You'll want to be there. You won't want to miss it. Just go to landscapesummit.co, sign up yourself, your manager, a spouse, bring some of your employees. It's a great event for team building, as well as just staying focused on the goals that you have for 2022 and beyond. Without any further delay, let's keep rolling the keynote.
All right, we're going to be talking about all of these at the conference, but I wanted to go over these right from the beginning, because right now, when we talked about volume here, we really talked about, in the second part, there's really a two-part equation of the volume part, right? We talked about increasing services, something that I'm not super fond of because some people go to that right away, increasing the number of services that they offer the customer in order to increase the amount of visits, increase the value per year per customer. A lot of people go to services when it comes to volume right away. The part that we're going to talk about for the rest of this keynote here is going to be about really increasing customers, getting more customers, all right? And this is the fun, sexy thing that everyone wants to hear about, increasing customers. They don't talk about these, all right? And we're gonna go ahead and spend this 1 hour on customers, increasing customers, and getting more leads, all the rest of it. And I'm going to do it because I want to specifically talk about a couple things in terms of feeding the beast with marketing and getting more customers. But remember, this is just one lever. Getting more customers is just one lever inside of your business. A lot of people go out and they try to get a whole bunch of new services, add new trucks, equipment so they can do different types of landscaping, hardscaping, whatever. Or they go out and spend a bunch of money on marketing, getting more customers, and they forget that there's all these other levers in your business that if tweaked just a little bit can have a massive effect. So just remember, as we go out for the next 30, 40 minutes and we talk about increasing customers, remember it's just one lever inside of your business. Literally, again, one thing this whole weekend, one little tweak on one of these levers could completely change your business. We're going to talk about a whole different, your tips and ways that you can improve your business and all this stuff. P4P and profit sharing and culture, they're all going to be great. One of them on the correct lever could change your business. Keep that in mind, because literally you're going to get so many ideas the next few days. You're going to be so enthusiastic about the change you're going to make and just like, let's go. Cool, but remember, literally just changing the price by 5% could make your profit go up by 50%. Little levers in your business like that can change your business. Every single one of these categories, I truly believe, can turn a profitable company into a very profitable company, or an unprofitable company into a profitable one. Something like accounts receivable can take a profitable company, make it actually cash flow positive by making sure that they actually get paid sooner. All right, so I want to make sure we just made that very clear, because now we're going to dive really deep on getting more customers. Number 2, which is the volume lever. Okay, so what I want to do is I want to just kind of break down in really simplistic terms how you look at growth and increasing the number of customers that you have. And if all of that lever stuff kind of seemed like airy-fairy, don't worry. Now we're going to jump into more tactical things in your business that you can actually use. All right, so I'm going to go through an example, and you can make this example up yourself, but don't worry too much about doing this example yourself, because on Saturday, we're going to actually go through the entire 2021 and make sure you have this broken down per month, and we're going to go in deep detail. But before we do a little bit of work on the Excel spreadsheets now, I want to do an example on the board, all right? And what we're going to talk about here is a business that wants to increase their recurring annual revenue, all right? So this business wants to increase their revenue by a certain amount in the year, and this again is going to be the amount of increase, all right? So this is the increase. This is not total revenue, this is the increase. So when we look at next year getting new customers, getting more volume, this is going to be their number, all right? I'm gonna walk through this and we're gonna fill this out in just a second. So let's say, for example, they want to do $200,000. In this example, we want to increase our recurring annual revenue by $200,000, okay? How we're going to come about that is we're going to first figure out, okay, well, let's work the numbers backwards. What's the price per job? Okay, so let's do price per job. Then we gotta figure out how many jobs per customer. So number of jobs per client, customer. Again, you can increase this by adding more services, making sure you can do fertilization for them, making sure you can do one cleanup, not just one, but two cleanups, things like that, okay? So number of jobs per customer, we gotta do our, divide by our conversion rate, and then we're gonna divide again by our retention rate. Okay, this will make sense in just a second, all right? But I just gotta kind of point all these things out. All right, so how we come up with the increase in recurring annual revenue of $200,000, we gotta figure out what's our cost, how much do we make per job? What's the revenue per job multiplied by how many jobs do we do for that customer? Then we gotta remember that we're not going to actually get all of our leads. Not all of our leads become customers. What's our conversion rate? Okay, we'll talk more about that in a second. Then what's our retention rate, okay? So this is gonna be the equation. We're gonna talk about these in a little more detail, but let's figure out first, what do we need to do in order to get $200,000 in annual revenue, recurring revenue increase, okay? So let's first off assume that we are gonna charge $50 per job on average, again, on average for our per job. So let's say, for example, like a mowing company, right? $50 per job. Now we're gonna ask ourselves, well, how many jobs per customer in this year are we gonna do? We're gonna go ahead and use 30. The reason I'm using 30, even though for most of us we mow more than that per year, or if you say, well, I mow 35 times and I do a couple cleanups or a couple bush trimmings, like I service people like 40 times a year. I'm gonna put 30 because some of your clients will accept, in this scenario, middle of the year, and they're not gonna get all 40 of your services. They only get 10 or 20 or 15. So they're not gonna necessarily all accept day one of January, right? So let's just assume that there's 30 jobs, number of visits or number of jobs per customer that you're gonna come service their property is 30, okay? Again, averaging out the fact that some people are gonna join mowing services in July, and you're only gonna get 12 or 15 visits before the end of the year. All right, then we gotta divide by our conversion rate. Now let's assume that our conversion rate is 50% or 0.50. So conversion rate, when we say conversion rate, we mean people that are becoming from leads into customers. Again, you gotta look at every single one of these things as levers in your business, as part of this equation, things that you can change. But conversion rate, I see so many times when companies are literally running like a 15-20% close ratio or conversion rate, and they're like, I'm trying to grow, I'm spending all this money on marketing. Literally, if they just went from 15% close ratio to 45% close ratio, they would triple the amount of business they get. So again, it's all about levers, okay? All about levers. Let's go ahead and assume that 50% of the people who get an estimate accept. So 50% conversion ratio. And now we gotta talk about retention rate. So a lot of people are like, well, I keep my customers forever, they never leave, no one ever complains. But there's definitely going to be a percentage of your customers that leave. And on average, let's just go ahead and say 0.8 or 20% of your customers are going to leave every year. That basically means the average lifespan is 5 years because of either complaints or they move or they pass away, whatever it might be. There's gonna be a level of, hey, I get a customer, I mow them for 3 years sometimes, or I mow them for 15 years. But like, let's say on average that's 5 years, which would impute a 20% loss every single year, or 80% retention every single year. So now what we got to do is we got to figure out, okay, well, how many leads am I going to need? Like, all I want to know right now is, everyone says, what do I need to make more money? What do I need to grow? I want to grow to 500,000 next year. What do I need to do? I did 300,000 last year. I want to add 200,000 so I can make 500,000. What do I need to do? This is the math you need to do right here. You need to figure out what your average cost per job is, how many jobs you do for the client in each year, and then your conversion ratio and your retention rate. All right, your conversion rate and your retention rate. All right, so what do we got to do? We're going to do 50 multiplied by 30 divided by 0.5 divided by 0.8. So if we do that, if you run those numbers, you're going to come out to 333 and a third. For the sake of just whole numbers, I'm going to do 333. And that is the number of leads that you need in order to get $200,000 in recurring revenue. Everyone's like, we talk about dollars because it's just like an easy thing. Like, oh, I want to grow by X amount. Okay, great. Well, how many customers are you going to need for that? Well, I don't know. How many leads are you going to need? Well, I don't know. How much does it cost you per lead? I don't know. Like, you got to know these numbers. So right off the bat, I know I want to increase my revenue by 200,000 next year. And don't worry if you're freaking out right now. We're going to do this for your business on Saturday. We're going to look at what your projected increase you want to get next year is. We're going to run all of these numbers for you. But I want to give this example here to set up something for you in just a moment, okay? Because right now we're actually not even talking about what I'm showing you here. I just need to set this up to get some numbers to show you the power of marketing. That's literally what I'm showing you right now. 333 leads is what we need. Now, let's assume that our cost per lead is $50. So cost per lead equals $50. Now, everyone always asks me, how much should I be paying for ads? How much I should be paying for leads? Is it worth it to spend money on Facebook? Is it worth it to spend money on Google? I spent $500 and I only got a couple. I spent $300 and I got 20. Like, everyone's not knowing, well, what should I pay? What should I pay? And they want like a hard number. So here's the hard numbers with a massive asterisk next to this saying it all depends on your market, on the time of year, what type of services you're selling, what type of, just a massive variety of things. Because if I'm selling $200,000 landscape projects, my cost per lead is gonna be a lot more than if I'm going after mowing customers, okay? But in general, if you're doing maintenance and mowing customers, which in this example, we're doing recurring annual revenue increases, and we're talking about mowing customers, I am willing to pay $50 per lead, and I'm willing to pay $100 per customer. Anything below that is awesome. When I start getting above that, becomes like, depending on the time of year, whether or not I'm happy, it depends on what type of services I'm selling, all that. But in general, very, very general, every day of the week, if I can get a lead, an estimate for $50, great. And if I have a 50% conversion ratio, I know that my cost per customer, or my acquisition cost is going to equal $100. So for me personally, again, very broad, massive asterisks over there depending on your services, but for me personally, when it comes to mowing, if I can get a lead for 50 bucks, great. If I can get that customer at 100, great. And the reason I do both and not just the 50 is because sometimes my conversion rate will be dramatically different based upon the type of marketing that I do. For example, if I do a Google Local Services ad and I pay $12 for a lead, there is like literally a 50% chance they're going to become a customer. Very high quality lead. Whereas if that same lead comes from a call now button on Facebook, I might have a 20% conversion rate on them. So I have a cost per lead, kind of generic $50, and an acquisition cost of $100. Because if I close every single lead that comes from a certain marketing method, I'm willing to pay $100 basically per lead because I know I'm going to close 100% of them. So this is a general rule of thumb, very general. Again, I can't overemphasize the asterisks, but $50 cost per lead, awesome deal. Anything that or below, fantastic. Acquisition cost, $100 for a mowing customer, anything below that, awesome. And we're going to talk about it, and I've said this before on the podcast. Some people are like, my goodness, I got to spend $10,000 and I'm only going to get like 100 customers. It's like, yeah, 100 customers could be a $250,000 business. Like, we got to take this into some perspective here, okay? And that's what I want to show you here, is feeding the beast. So let's talk about these numbers, use them to make an illustration here. So in this example, we have a $50 cost per lead. Now, in order, okay, let's go ahead and mark this off. This is useless. So our cost per lead is $50. Now what we can do is actually create a marketing budget. This is how you create a marketing budget. Okay? We get our numbers, we get the number of leads that we're going to need in order to get this revenue. And then we go, okay, well, what does it cost per lead? Well, $50. Well, if I multiply these out, I can literally know that my marketing budget, let's see here, my total marketing budget, marketing budget, in order to get all of these customers is going to equal $16,667. Bam. Now, some people are like, that's crazy. Why would you, like, that seems insane that I'm gonna have to spend $17,000 on marketing, and I'm gonna go from $300,000 this year to $500,000. I'm gonna go from $800,000 to $1 million. I'm going to increase my recurring annual revenue by $200,000, and I gotta spend 17 grand. Like, some people would spend 17 grand, and if they only increased by 200, they're like, that was a pathetic marketing campaign, that was a bad year, whatever. Let me explain just how awesome this is, okay? Let's go ahead and assume if this grosses 400,000, let's see here, 1 second. Yeah, okay, there we go. Okay, perfect. So we are going to assume that this $16,000 gives us $200,000 in revenue. Now, we also need to assume now, I'm gonna have to get different colors so no one gets confused. Let's go ahead and assume, let's assume a 40% profit margin. All right, not 40% profit, 20% profit margin. All right, so if we do a 20% profit margin, that is going to equal on $200,000 in increased revenue. Remember, this is not total revenue. This is the increase in revenue due to us spending $16,667 on marketing. Generates $200,000 in new revenue at a 20% profit. That's going to be $40,000 in profit because we spent $16,000 in marketing. Basically, we spent $16,000 in marketing to get 333 leads, and we needed that many because we know our retention rate, we know our conversion rate, we know what our cost per job is, and how many services we get per client on each year on average. And that's going to generate $200,000 in annual revenue. And because we know 20% profit, which is a very well-run business, we're gonna have $40,000 in profit because of this marketing dollars. Now, let's go ahead and look at a couple things here. The reason that many get discouraged is because to sustain this kind of growth, most of that $40,000 will be spent on trucks, hiring, equipment, office, storage, etc. Okay? So everyone's like, oh, this is great. This is $40,000 in profit. The problem is, guess what? Next year, we also want to get $200,000 in increased revenue. What we're going to have to do is we're going to spend this $40,000, go buy a couple trucks, hire a couple more people, maybe have to get some office staff. All of a sudden, that $40,000 is poof, gone, because the next year, we're continually growing. And then that year, we have a great year. We invested into marketing and all the rest of it. We spent the $40,000 from last year in marketing, and now it's growing. But guess what? Now we need more trucks, and we need more equipment, and we need more people. And that vicious growth, again, growth sucks cash. And that's why so many people, as they grow in their business from especially 100 to 200,000, from 200,000 to 350,000, those are massive jumps. And those are massive percentage jumps, and therefore you might be profitable, this company 20% profitable and making 40% profit on paper, but that money is now needed in order to sustain the next year's growth, because we might have spent $16,000 in marketing, but we had to buy trucks, we had to hire more people, all of those things, those fixed assets, the storage, getting a bigger yard, the overhead expense, now that's starting to eat into that $40,000 in profit, okay? This is why so many people get discouraged, is because they're like, I'm growing and I feel like I'm doing everything right. And this year 1, year 2 especially, those are the hardest couple years, and they get discouraged. Now, I want to talk to you first in terms of those of you who are growing and you don't feel like you actually see the money coming in. First of all, I would be looking at those other other 6 levers. We talked about the 7 levers. I would take my eye off of volume and say, can I raise my price? Can I increase my accounts payable? Can I reduce my COGS? I would look at all those other 6 different levers besides volume before. However, you need to keep something in mind. And that is that growth, when you're growing a business, you are building an asset, okay? So let me go ahead and erase some of this stuff right now. Let's go ahead and erase this, just so I have some space so I can write. When you're building a business in this industry, it's important to know that even when you're growing, if you're building the top line revenue, you are building the value of the business in terms of like your net worth and your wealth, okay? You are building an asset, right? Whether it be the trucks and equipment, like yes, that's an asset. But if if a business is growing, like if you look at the stock market, when a company's hitting parabolic growth, like their valuation goes through the moon. And so if you're growing very consistently, there is absolutely value that you're building. So we're going to assume a couple things. I'm going to talk about valuation for just a second. And I'm doing this to encourage those of you who are in your first, second, third year who feel like you are profitable, you are doing what's right, but you literally feel like you're not seeing any money. And the reason is because you're growing. Growth sucks cash. But let me encourage you by the fact that yes, you might not see the cash necessarily, but you're building the value of an asset, okay? So, for example here, $200,000, we're increasing the annual revenue. Let's assume that all $40,000 of this profit gets sucked up into new trucks, equipment, and marketing and hiring for the next year. So literally we don't actually see the money, like it's there on paper, like we know we made it, but we have to use it to sustain the growth for next year. So let me encourage you though by saying this. Let's assume that in this industry, there's a couple ways to value businesses in this industry. A really well-run business, especially like mowing, let's just use mowing for example, can easily trade at 1 times a multiple of revenue. And when I say trade, I mean like sell. If you're trying to sell 1 times revenue, you can easily sell a good, well-run business. What that means, if I'm doing $1 million business in revenue every year, there's a really good chance I could sell that for $1 million. All right, just again, very, very broad acquisition price, but a great way to value a company very simply is like 100,000, 1 times the revenue is what the cost and the value of that business is. So using this valuation technique, I could literally say, hey, I might have only profited $40,000 from my $16,000 expense, made 40 grand, had to go spend it more though on assets, equipment, trucks, hiring people, more space, office, whatever it might be, so I can keep growing, but I don't even actually see the money. Like the money never came into the bank. I never got $40,000 richer this year. But what you did do is you made your revenue go up by $200,000, which in essence basically means your net worth went up by $200,000 using this valuation technique. All right, $200,000 is what your net worth went up. And we always talk about profitability, and we should. We absolutely should. And I talk about it all the time. But there's absolutely an element to the fact that when you're growing top-line revenue growth, top-line revenue in those first few years, you've got to focus on the fact that you're building an asset that will one day produce cash flow, okay? Again, all of this has a massive asterisk next to it saying, look at those 6 other levers before you think about what I'm talking about now, which is like, hey, I'm building a net worth, my net worth, and literally I created $200,000 worth of an asset in the business this year. I might not have seen any profit, but I build an asset value. I see companies that literally the founder is depressed or is anxious to like, look, I went from 150,000 to 350,000, then to 600,000. Next year I'm going to do 900,000, but I don't see any profit and I just feel like I'm a horrible business owner. I'm doing something wrong. It's like, no. Let's step back and look at the fact that in 4 years, you create an asset worth $900,000. That's incredible. And so that's one way to encourage yourself, especially when you're growing. Now, eventually, you're going to slow down growth. You're going to look at those 6 other levers and increase your prices. You're not going to grow anymore, and it's going to become a cash flowing asset. But when you're building, you've got to buy trucks, you've got to hire people, all the other stuff that goes into it. Now, another valuation technique that people use in this industry, and in kind of more of a common, business valuation, is assets plus 3x profit. Okay, that's another valuation method that someone would use to value the value of your business. Because again, we're trying to build an asset here. We're trying to build a business that's worth something, and not just worth your assets. A poorly run business that can't run without the owner, that doesn't have systems in place, doesn't have a consistent profit margin, literally worth just the assets. So let me be very clear. If you're just gonna grow your business to $200,000, have one employee, you're only gonna be worth literally your assets and maybe a little bit of money for the contacts and your contracts. Like, that's the value of your business. But if you build a business that actually has systems and has consistent cash flows, and even if it's a $500,000, $600,000 business, but you literally have 6 or 7 employees, they all run their own thing on P4P, you show up for an hour a day and it basically runs itself, that's worth something. That is an asset, okay? And in that case, you can value it at 1 times revenue, or you can value it, again, assets plus 3 times profit. So for example, on this business up here, let's say for example, let's say this company did $300,000 last year, and now they've grown it to $500,000, okay? So they've grown it to $500,000, they're at 20% profit margin, so let's say $100,000 in profit margin, so 3 times their 100K, so profit per year, and multiply that by 3 plus the asset value. This is like your trucks, your equipment, etc. And again, this is not like what you bought it for when it was new 5 years ago. Is what is it worth today? Like, if they had to go buy these things elsewhere, what would they pay for it? Let's say, for example, it's a $500,000 business. Maybe there is $150,000 worth of assets. So in this particular example, this would equate to a $450,000 business. Now, you say, well, that's pretty close, because up here, if I would do 1 times revenue on this business, what would it be worth? It'd be worth a whopping $500,000. All right, so pretty close. 500,000, 450,000, an approximate valuation method for your small business, okay? Again, all of this falls apart if you were just running the business by yourself, if you don't have any systems, you don't have P4P, you don't have any sort of systems or structure to your employees, getting them trained, having an estimate process, having an office, the sales process that's very smooth, where you can leave for 2 weeks. Like, if you're trained to the job, this is not your valuation method. I'm talking about a well-run business. So remember, that's why as the business grows, it seems so hard, because you're really not, the asset value isn't really there until you actually got to a point where you have the money, you can create the systems, you have a team in place, and that's when these valuation methods become more pertinent. And yes, some people are going to say that's low, because certain types of businesses in this industry will exchange and sell for 2 times revenue or something like that. But this is just very general. It's a way for you to encourage yourself as you're getting to the point of maybe $1 million in revenue, if that's your big goal. Have a team, have systems in place. If you go from 0 to $250,000 in 1 year, you built a $250,000 asset if you continue to grow that business to the point where it is of value down the road. So keep that in mind. I need that for you to be encouraged if you're in that first year, second year, and you feel like you're grinding and you're not seeing this profit. Remember, you're building your net worth. And when we look at real estate, when we look at stocks, the only thing I as an investor care about is I care about my net worth. Because at the end of the day, net worth doesn't get taxed, okay? This $40,000, this is the secret of investing, and we're not gonna talk a lot about investing, but let me be very clear. The reason everyone loves real estate is because the profits you get from it, you can literally deduct, and you don't have to pay taxes on it, okay? The thing about revenues in your business is I have to get taxed on my $40,000 in profit. I would get taxed on that. But me building a business, breaking even, if I built a business and I'm growing really quick, I break even, I have built a net worth, a value, an asset that's worth hundreds of thousands of dollars. And I don't have to pay any tax on it. Literally, I could break even on paper, I don't get charged anything, and yet I'm building an asset. That is where the real value in small businesses is, building the net worth, your net worth as a personal, because of your ownership, your stake ownership in a corporation, i.e. your business. Now, let's see here. I'm going to take a break here, because now we're going to kind of take this, and I wanted to, first of all, encourage you in terms of the value of investing in marketing, making this money in profit, all of these things. And now we're going to take these numbers, and I know that some of this has been a little bit chopped up. I'm going to bring it all together on an Excel spreadsheet. And we're going to actually look at Because some people would literally be freaking out. Like, I got to spend $16,000 in marketing. I would imagine that most people watching this haven't spent $16,000 in marketing a whole year. And yet they're wondering why they didn't triple their business from 500,000 to $1.5 million. Like, you got to do the numbers. We have to get 330 leads at the end of the day. Like, math doesn't lie. And so in order to get those, we have to spend $50 per lead. And in order to do that, we have to spend $16,000 in order to get to our annual revenue. That's why on Saturday, before you leave this conference, you are going to leave with, how much am I going to grow next year? What's my cost per lead going to be? What's my retention rate? What's my close ratio? How many leads do I need to get? How many do I need to get this week? Now, like, if you can just break this down, like, okay, I have 330 leads. Okay, I better get at least one a day. Basically, I need to get one a day. If I start looking about, okay, I have a season of 8 months. Okay, I need to get 2 for every working day of the year. What do I need to spend? Well, I'm going to spend, I need to go $50 per cost per lead. Well, if I need 2 per day, I better be spending $100 per day to get those 2 leads. These are the numbers you need to know, and that's why people freak out when I say $100 per day you're spending on marketing. That's incredibly insane. No, I'm only getting 2 leads. Therefore, I'm getting 1 customer because I know my close ratio is 50%. And I need to get that 1 customer because I need to get at least 1 per day. And, well, in this case, I'm talking about customers, so take that back. I would need $50 per day to get that 333 leads in the year. But again, let's assume that we only have 6, 7, 8 months of a time, a window, a season. I need those 2 leads per day. I need those 2 leads per day times 150, 160 days out of the year. I need to be spending $100 per working day of the year to get my 2 leads. All right, so running the numbers backwards, very important. That way you don't get unexpectedly disappointed by your numbers. And if you are disappointed by your profits, remember that if you're growing your business very quickly, you're building your net worth. So that's the growth part of the equation. Like, we're really trying to add volume, right? Now let's talk about why feeding the beast, spending money on marketing, if you know your numbers and you know your cost per lead, is literally one of the best investments you'll ever make. Not only for the net worth side of things, but also for the cash flow. And really thinking about retirement now, thinking about growing this business, feeding the beast. But why do we do this? Why does it feel like we keep pumping money into marketing, not really making a whole lot of profit? What's the end goal here? It is to build a business that is profitable, systems-based, and you can literally retire and the money keep flowing in. Let's talk about this. I want to get you inspired about the potential of your business once you've fought through year 1, 2, 3, 4. It's starting to get a little easier now. 5. This is where we're trying to go. Year 5, 6, 7, where now the business is in a very profitable state, does not require you to be there on a daily basis, and is one of the best ways to retire. It's easier to retire with a small business than it is with stocks, bonds, and real estate. All right, so here we are. Hopefully you're able to download that. You can see that there's the code that you can use to scan it here as well. But you're gonna wanna make sure you're looking at this and you can edit these numbers yourself. Before we actually dig into filling in some of this information for yourself, I want you to look at this. And that is, using our last example, we talked about this business that spent, let's just type it out here just so we're all on the same page. We spent $16,666 on marketing. And that created $40,000 worth in profit. Now, if you look at that from an ROI standpoint, you made a 240% ROI, okay? In real estate, we talk about cash on cash returns. If you're looking at cash on cash returns, we made 140%, okay? So ROI of 240%. Basically, I spent $16,666 in marketing and made $40,000 in profit. If you look at a small business like an investment vehicle, it's phenomenal, okay? If we look over here, the asset classes over the past 15 years, this is their best years, their worst years, and their annualized average over the past 15 years. Large cap stocks are the best at around 8%. If you got like high yield bonds, 6%, 4, 5%, REITs, which is real estate, 5.3%. And just like incredible. There's really bad years where literally, emerging stock market 50% negative, then it's up 79%. Like, it's incredible returns sometimes and horrible returns others. And then you got cash, which like hardly moves at all. So these are the different asset classes, from stocks, bonds, real estate, cash, all sorts of things. And this is the annualized percentage of return on those assets. Now, when you compare that to a small business where I can make 240%, in a business, again, we were assuming we made 20% margin. So it's a well-run business. But again, $16,000 spent, that's my investment, and I made $40,000 of profit in the first year. An incredible investment tool. Really, it's an incredible thing. If you start looking at what the value of the recurring revenue is going to be in year 2, and the lifetime value of that customer, and the profit that you're going to get for them over the next 5 years, the return on that $16,000 is amazing. This is why I love recurring revenue. This is why I try to get people to focus at least somewhat on recurring revenue, even if they're in design build, because the power of getting a customer for $100 and then making $500 in profit the first year, and then $500 the next year, and then $500 the next year, and doing that for 5 years, the ROI from just an investment standpoint is incredible. If I have $10,000 and I'm considering spending it on a real estate fund, or I'm thinking about spending it on stocks, if I have a good business and I can spend $10,000 in marketing on that and get a massive 240% return, that's incredible. The power of a small business, the beast, the machine that it is, if it's ran in a smooth and systematic fashion, is by far and away the best ROI you can have when it comes to an investment tool. Whether it be stocks, real estate, whatever it is, not only is it a better ROI, you have full control over it. You cannot control if the real estate market goes down. You cannot control if your stock in Apple goes up or down based upon if they did a bad manufacturing mistake, or Tesla or whatever. You cannot control that. A small business, you get to determine who you hire, how you market, if you have a website, what kind of services you offer. You control it, and it can have the best ROI of any asset class that's available. And that's why things like Shark Tank, you got people like wondering why these sharks spend $100,000 here and $200,000 here. Because if they can spend $200,000 and over the course of the next 10 years get $500,000 back, that's a great ROI compared to the rest of their asset classes. They're doing 4 and 5% every single year. Small businesses are an incredible machine. Feed the beast. Once you have systems in place, if you can spend money on marketing, you should. All right? I see so many people losing out on opportunity. They've created a well-run business, but they're afraid of spending $1,000 on marketing. It's like, look, and yet they're spending money in stocks right now, and they're trying to buy real estate for an investment. It's like, why would you spend $100,000 on a piece of real estate that over the course of maybe 10 years will double in value, when literally that $100,000 could become $500,000 in a year or two if it's put into your business? Again, we're just talking about ROI in terms of profit. We're not even talking about the fact that when you're getting this $240,000 in profit, we increased our net worth by $200,000 in our last example. So let's jump into this though and start thinking about your retirement, okay? We're gonna use these other tabs later on Saturday, but let's talk about right now feeding the beast and really think about using your small business as a way to think about retirement, okay? So first of all, these green boxes are the ones that we need to put your data in, and we're going to use some examples now, but these are the ones that you need to put your data in, and then the red is, don't touch those basically. Don't touch the red ones here. So let's, first of all, you got to ask yourself, how much money do I want to make every single year so I can retire? Like, how much money do I need coming in passively for me to be able to just retire? Okay, well, if we put in, let's say I want $100,000, and I feel like if I got $100,000 every year coming in passively, I would be happy. I could retire on that. I wouldn't have to work another day. Now, in order to do this using stocks, bonds, real estate, etc., let's determine first of all how much money we would need before we retire, okay? So let's say, for example, if we look over here, these annual rates of return, let's go really, really optimistic and say that like we have like a well-diversified portfolio of bonds, stocks, gold, all sorts of stuff. Just a really good, diversified portfolio. Let's assume a 7%, just for the sake of this example. And you can throw these numbers in here. As I'm working on this, you do this for yourself, and you can play with these numbers. This is the beautiful thing about the spreadsheet. It's all calculate. Just don't play with the formulas. You can play around and see, okay, well, how much would I need to make? What size of my business need to be, etc. All right, so if I am going to retire and I want to make $100,000 on the investments that I have, I need $1.4 million in order to be able to invest in the market and make 7% a year and get that $100,000 coming to me every year based upon that 7% figure, okay? I need $1.428571 million on day one. And I know some people are going to start trying to prick holes and do inflation stuff and all this other stuff. Don't worry about it. I'm trying to make a point here. Just get the point. Don't worry about too much about the numbers. The numbers are close enough just to get the point, okay? Now let's look, okay, this is your diversified portfolio. This is you trying to retire when you're 50, 60, 70, 80 years old. If you ever want to retire, let's just assume though, you want to retire and you want a certain amount of money every single year coming from your investments. If we made 7% a year, which is very good, if you have a diversified portfolio, 7%, we need $1.4 million in order to retire. We need that in the bank, principal. Now let's look at your lawn care business. All right, we don't have $1.4 million in the bank. We don't think we can do it in the next 5 years. What about your lawn care business? Well, let's assume that this business does $700,000 in revenue, okay? Let's assume that the profit margin is, let's just be conservative and say, let's say 16%. 16% margin business. Literally right there, net profit is $112,000. That's literally more than over here. So let's bring it down a bit. Let's say, okay, you know what? Let's just be a little more realistic. Instead of 16%, let's do a 14%. Oops, sorry, 14%. There we go. Oh, I messed this up big time. Oh man, I messed up my formula. Give me 1 second here. So we're gonna make this a percentage. There we go. I'm going to go into here. I'm going to go 0.14, boom. There we go, perfect. All right, so my net profit margin, oh, I see. Now if I click percentage, there we go, 14%. So don't worry about that too much. Basically what I'm using is a percentage. If you messed it up like I just did, 0.14 would be the same thing. I just click the percentage button up here as format as a percentage. All right, so say, you know what? Let's not do 16%. Let's be a little more conservative. Let's say 14% margin. Because I don't want to be in the business. I want to have systems. I want to have a manager in place. I want to have a team that's running on P4P and profit sharing. And I do not need to worry about them every single day. Like they operate without me. A net profit margin of 14% is going to give me $98,000 every year in profit, which literally means down here, which is easier to achieve? Either A, stashing away $1.428 million so I can put money in a well-diversified portfolio. That's going to be very difficult to get to, $1.4 million. Or is it easier to create a business that generates $700,000 in revenue and with a 14% profit margin? Like I genuinely believe this is achievable for most people in 5 years. It is not achievable for most people to get to $1.428 million in the next 3 to 5 years. It's not. So I really look at our small businesses as number one, an investment tool. Number two, I look at it as a retirement avenue. Like you can either retire by having a whole bunch of money and putting it in the market, or you can retire by creating a business that's systems based and can run without you and then live on the profits, okay? And like honestly, some people will never retire. Some people, they want their business just to keep them active. Like maybe you only work 4 hours a week. But when you're 67 years old, that's great. Keeps your mind active, keeps you engaged, but you're not working every day. You can leave for 3 or 4 weeks on vacation. Everything runs fine. We are assuming in both of these scenarios that we maybe spend 5 hours a week, either A, managing our portfolio, or B, managing our business. Okay? So basically passive, a little bit of work, either A, working on our portfolio, or B, managing our business, making sure we do a staff meeting. This is exactly what I do right now at our first location, right? Coming a couple times a week for team meetings, have great management in place, have P4P in place, profit sharing in place. The systems run the business, okay? This is what you want to be shooting for. This is the goal. All right. So whether you're trying to retire or you're just trying to make it where you can go work on something else, start another business, go do something you're passionate about, or maybe you take this $98,000 in profit, you're not trying to retire, and you go take this and you invest it into a portfolio of stocks, or you invest it into real estate because you're younger. But again, this is a great retirement vehicle. It's a great investment tool because literally, the numbers that we used on the last business, the business we used on the whiteboard over there, literally 240% ROI. You're not getting that in the stock market. If I put $16,000 in a stock today, I am not going to have $40,000 in profit, i.e. $56,000 worth of value in those stocks. That is like unlikely, 1 in 100 shot. You're gambling basically in the stock market if you get those type of returns. Whereas the numbers we showed are absolutely viable and absolutely possible in your small business. So stop trying to convince yourself to stop spending money on marketing. If you've created good systems, if you have a good team in place, you should be putting money in your business first. Literally, if I said to you a year ago, hey, what about putting money in Tesla? And now, with hindsight, a year later, like, oh, I should have done that. Like literally, it's gone up 4 or 5 times in the, 4 or 5x in the past year. Like that would be such an awesome, investment tool. Let me tell you this: if you have good systems in place, if you have a profit margin that's healthy, 15+%, your small business is absolutely the best place for you to invest your money. And I'm saying this because especially in the past year, we got Robinhood investors, it's easier to put money in the stock market. I see young business owners putting money in the stock market. I'm like, look, if you spent that money on marketing, you could double the size of your business. The doubling of that business increases your net worth. You're building your net worth like we showed in our example. And not only that, if you're having a profitable business, you literally have the best return on investment you could ever have. Compared to stocks, compared to real estate, I don't care what it is. Yes, there's 3-5 years of hard work and growth and hiring and trying to figure out who's going to be in the team and who's going to be the manager, figuring out P4P that we're going to talk about. It's not going to be easy to change. Implementing P4P, having a great culture. These are things that are not easy. But this is what we're trying to go for. Creating a machine, a beast that we put money into and we get an incredible ROI back. This 240% ROI isn't even taking into account years 2 and 3 that $16,000 in marketing generates because that customer stays with you. That's the power of recurring revenue. And that's the power of creating a business that's system-centric. That's the power of having P4P where you can run a business with only 4 or 5 hours a week. You can't do that if you're paying people by hour and you're having to manage them and check where they're at and wondering if they're on their cell phone, tracking their trucks, seeing if they're stopping at McDonald's, stopping at every single gas station. You can't do those things. The systems that we talk about on this weekend, this conference, the systems we talk about creating a culture in your business is all governed around the one variable. Everyone looks at this spreadsheet and says it's impossible. And that is that they're not going to just be able to spend 4, 5, 6, 10 hours a week. They think that they have to spend 80, 90, 100. And you do in year 3, 4, 5. The ones where you are spending that $16,000 in marketing, $40,000 are coming in profit, and literally you don't see the profit because you're investing into trucks and equipment and getting to the next year of growth and building your net worth, and you're not necessarily seeing the profits of your business. I want to make this very clear. If you're young, years 1 through 5 in your business, don't lose heart. Keep the net worth in mind. As you build the gross revenue, remember you're building an asset. You have to balance that with the other 6 levers that we talked about. You might need to increase your price for a year, take a step back on growth, and really allow you to get some profit under your belt so you can provide for your family. But if you can take whatever profit you have and put it into the machine of marketing and get that $50 cost per lead or lower, that $100 customer acquisition cost or lower, you should be pumping money into your business. Let me get very clear to you. If you're just in that starting point, do not lose heart. If you're in that middle ground, 4, 5, 6 years you've been in business and you're starting to really grow and you're actually starting to see some profits, invest it back into marketing. You'll grow very quickly, that asset value will increase, and you're going to see much better returns on your money compared to any other asset class. Small businesses have an incredible return. I hope that was helpful. Let's go ahead and take a few minutes break. Hopefully that you can digest some of that. Play with these numbers, figure out, okay, well, what if I did, I didn't do 7%, I only did like 6%. And what happens then? Well, then I need 16,000, I messed this up. Again, I messed this up. Let's say it's 0.06 is going to be our return. And now you need $1.6 million before you can retire. Okay, well, what if I want to live the life? What if I really want to live it up and I want $200,000 for every single year when I'm retired? Well, you're going to need $3 million. You're going to need $3 million to operate. Well, what would I need to build my business to instead of building $3 million worth of cash in the bank? Well, let's say we do a $1.5 million business. That's the goal. Okay, and you know what? Let's be a little more conservative. Even more so, let's say 13% is going to be our profit margin on the business. Well, look at that. $195,000 in profit by having a 13% margin business, which is very possible. $1.5 million in revenue. You're going to see here, later on this weekend, we're going to talk about my businesses. And our business this year did a little over 1.7 million in revenue. Net profit just under 20%. And yeah, the net margin of a little under 20%. Yeah, net profit was around a little over $300,000. And so these are things to think about. These are things to think about because literally if I was to make that equation here, in order to retire, you'd literally have to have millions and millions of dollars in cash. You got to start thinking of your business as an investment tool, as an investment in net worth and in recurring revenue and in a rate of return, just the same way you would when you think about real estate or stocks, etc. So hopefully that was helpful.
Well, that's it. I hope that was helpful. That was just one keynote out of all of last year's conference. Now, if you want to watch that last year's virtual conference, the entire recording is available to all the members that sign up for landscapebusinesscourse.com. So if you can't make it to this year and you want to watch last year's recordings, it's available for everyone that's a member at landscapebusinesscourse.com. So just sign up and then you go to the very, very bottom of the modules and you'll see that Landscape Summit 2021's recordings are there. But you really should come in person, meet other landscapers. We're going to have a Thursday, Friday, and Saturday. Thursday starts at 4 p.m. So you can literally work Monday, Tuesday, Wednesday at your place and then literally fly out Wednesday night or Thursday morning, get here by 4 o'clock p.m. And we're going to have a great 3 days. It's all Thursday evening, all of Friday, all of Saturday, and there's going to be more than 12 keynotes just like this one that I'm going to be delivering in person, live, and looking forward to what 2022 is going to have on the horizon in terms of the economy, where the opportunities are going to be when it comes to marketing and different platforms, and what I feel is really important for this industry as we move forward with this labor market. So really looking forward to this event. Please come. If you got to cancel some stuff, if you got to get a subcontractor to cover you for snow plowing, look, I know in the middle of January you got snow on your mind. Trust me, even if you missed a snow event and lost a customer too, this event will absolutely pay massive dividends for your business in 2022. Again, every single dollar of the $299 per ticket goes to the event. The food, the venue, the speakers, all the stuff that we bring in, my whole team that's there the entire week. It's a lot of work. We lose money on this event, but it's the event I always wish I had when I started my business. And that is just straight business talk. No ads, no pitching, no trade shows and fancy equipment. I just want to know how to grow my business. So if you want last year's recording, check out landscapebusinesscourse.com and sign up as a member. Go to the very bottom, you'll see the recordings. But more importantly, if you can make it to this coming year in-person event, January 13th, 14th, and 15th, it's going to be phenomenal, and I look forward to seeing you there.